Hi, I'm Justin Zaks, Vice President of Strategy at Moomoo Technologies. I'd like to welcome you to our second webinar of our monthly 7-part series entitled Experience Options Like Never Before. This series will give viewers an exclusive opportunity to learn about a variety of topics related to options from industry experts at the Cboe. I will also be asking the Cboe experts about their presentation, their professional lives, their views on various topics related to options. You, the viewer, will also get a chance near the end of the webinar to ask questions. So make sure to watch the entire show. I wouldn't want you to miss anything. The educational presentation should be about 15 or 20 minutes, followed by the questions for about 45 minutes total. This webinar series is part of a broader collaboration between Moomoo and Cboe that includes several in-person events, the introduction of index options on the Moomoo platform last November. Speaking of these in-person events, Moomoo is going to be holding an event Wednesday, June 12th in Chicago at Cboe's headquarters about why you need a portfolio and how you can use options in assisting you to build one. It's going to be a free event. There's going to be several different speakers, including ones from the Cboe, to talk about various option strategies used to build a portfolio. We're going to have a few surprise giveaways, so mark your calendar and look out for the details in the near future via email, Moomoo social media, and in the Moo community. Today, I would like to welcome Nishank Modi, Senior Director of Cboe Labs at Cboe Global Markets. He's also an adjunct professor at Cboe's Options Institute. He's an expert at managing volatility exposure and has worked as a portfolio manager at Goldman Sachs. He's been an options trader and an options market maker at several other different firms. The title of his presentation is A Beginner's Guide to Options Trading Strategies. Nishank is going to tell us some of the reasons to use options, and then he's going to walk us through a few of the common strategies, including covered calls and cash-secured puts. Now, before we begin, make sure to go to moomoo.com/US to check out our current sign-up promotions if you're not already a client. Welcome, Nishank.
Thank you, Justin. Thank you for the great introduction. I'm so excited for today's session. Like Justin mentioned, we're going to talk about basic strategies. We're going to talk about options and how you can use these in your investment guidelines, in your investment outlook, in your goals, right? So so let's get started with what is the Options Institute. It's an arm of Cboe where we teach education. Please feel free to check out our website. Today's objectives are we're going to look at the reasons for using options and list the commonly used strategies, right? These strategies, like Justin mentioned, are covered calls and cash secured puts. We're going to look at how they work, what are the benefits and risks. And really, my aim from this is to talk through why would someone use them, when would you use it, when would you not use it, right? Like what are some of the common pitfalls? So Justin mentioned I've got a lot of experience trading options. I've been doing it professionally for over 15 years. And you learn a thing or two while you do that. I've traded options for institutions, for wealth managers, for myself as a retail trader. And I guess, one of the biggest, takeaways is really understand the product before you get into the trading aspects of it. Know what your risks are, know what your max downside loss is, know what profits you can make. But we're getting ahead of ourselves. Let's start with why do people trade options? So the two main reasons for trading options is to make money, right? To income generation, or for capital protection, which is you have some stocks, you have some capital, you have a portfolio of some names, and you want some protection or insurance on it. So think about calls and puts and how you can get that income generation from using calls or puts, or from or by using those to protect your capital. In terms of the commonly used strategies, right? They really fall under 4 different levels, and these levels and the strategies offered may differ from platform to platform, but generally speaking, right, you go from lower risk strategies, which are level 1 strategies, up to higher risk strategies, which are level 4 strategies. So, covered calls are common strategies in the level 1. These are basic strategies that have been around, I think, at least from the 70s, from before I was born. And level 4 is naked contracts, right? This is the stuff that you hear about in, in warning videos, right? Like if you're naked short an option, you could lose a lot of money, and that typically could happen. So that's the reason you have these approval levels. You have to qualify at each level to show that you'll have the knowledge and the experience to go from level 1 to 2, from 2 to 3, and all the way up to 4. So let's start here, right? So, what is our goal, right? Identify which strategies achieve your goal, right? And then compare those strategies to determine which ones align with your risk tolerance and resources. So what does that really mean, right? So, you're investing as an investor, you have some parameters in mind. You want to make money, but how do you want to make money? You think the markets are going to go up. Well, okay, how do you do that? You could buy a stock, or you could buy an index future, right? Or you could buy call options, which are bullish, right? Which means you have exposure to the upside. So there's many different ways to gain that upside exposure, or if you want to protect your portfolio, ways to gain that downside exposure, right? So you need to know what your goals are, and once you have your goals and your targets, you then select your strategy, you place your trade, and you review the analysis and the results. It is, it is important to really think through these steps one by one. So if I think of making money and making money because I think the markets are going to go up, I ask myself, why do I think the markets are going to go up, right? Which name in the market will go up? My view is that hypothetically, right, like I could have a view that some stock is releasing a drug that is going to cure cancer, right? Maybe that will make the stock price go up. I could buy that stock, I could buy calls on it, I could sell puts on it, I could buy a call spread on it. There's all different strategies in which you could gain that bullish exposure, but you then have to start whittling down to which one of these do I really want? What is my time frame? What is my risk tolerance? What's the max risk in each of these strategies? We will start with two really simple strategies today. The first one is called covered calls. And the second one is called cash secured puts. So covered calls is a strategy where you already have an existing position of long stock. So let's say you were long 100 shares of Apple, or 100 shares of Tesla, or 100 shares of SPY, or any other name that you have. And on top of these stocks, you want to make some income over and above any appreciation in the stock that happens, right? So the way to do that is by using covered calls, where you sell an upside call. Let's look at the P&L diagrams of how these look like. Another, I guess, like I'll take a tiny pause here to say, these are hockey stick diagrams, right? They show you the P&L, or they show you how much money you make from each part of the trade. I remember when I first started trading and started looking at these diagrams, they were really confusing to me. So, if you're at that stage, or if you don't really fully understand them, that's okay. Take the time to understand it. These are some of your best friends in understanding which option strategy to use. So let's break down what a covered call is, right? What is it? It's a long stock and a short call, right? Long stock means you own the stock or you buy the stock, and a short call means you're selling calls on that long stock, right? So selling calls is also called writing, right? These strategies are sometimes also called buy writes, right? A buy write is buying stock and writing calls, and you do it on a 1-for-1 basis. What that means is, if you have 100 shares of some stock in the US, you would sell one call option on that because there's 100 multiplier on the call option. So 100 Apple shares would qualify for one share of Apple call option. If you are long stock, which is the gray line on the left chart, right? That gray line shows you if you're long stock, when markets go up, you make money, right? So the right-hand side, you make money. It's a 45-degree line. When markets go down, you lose money, right? That should be fairly simple, right? If you're long stock and it goes up, you make money. It goes down, you lose money. What happens when you sell a call? Well, when you sell something, you make some money, right? You sell anything. When you sell an Apple, you sell your computer, you sell a house, you receive some premium for it, right? You receive some money. So step one is you collect money, right? You've sold something, in this case, a short call, at a given strike price. So there are consequences for that, which means that beyond that strike price, you may start losing money, right? So the green dotted line starts going down after the strike price. When you combine those two lines, which is the chart on the right, you see a much cleaner chart. You see a neater chart, right? And what that shows is you have risk to the downside below strike price, right? That's a 45-degree line. And it's a flat line above the strike price. And what that means is once you've hit the strike price on your covered call, you don't make any more money. You are capped out. So one of the common misconceptions of a covered call strategy or a buy right strategy is that it's easy money or it's free money. I would like to say both of those are untrue, right? You get paid a premium for selling upside or selling that opportunity cost. If your stock stays below that level, you make all of that premium. But if you go above that level, well, then your P&L is flat or you're stopped out and you don't make any more money beyond the strike price plus the premium that you collected up front. Right. So, what is the investment thesis? Why would someone do this? Right. You would have a covered call strategy when you're slightly bullish. Right. So you still think the stock will go up, but you don't think it's going to go up too much. Right. Or you're somewhat neutral. You own a stock and you want to make some money or make some extra income on the stock. Right. So in either of those situations, what you would do is you would continue holding your long stock and you would sell an upside call against it and collect some premium, right? So the break even is stock price minus the premium that you received. Your maximum gain, and this is important, right? This is the strike price minus the stock purchase price plus the premium received. So that's the max gain, right? You are capped at that level. And your max loss is actually fairly substantial, right? So these aren't necessarily protection strategies. It does protect you for a small move down, right? But beyond that, you do have losses. So it's not like buying a put. You have some coverage, but beyond that, right, the max loss is the stock purchase price minus the premium received. I usually find walking through option strategies is easier when I have a use case. So, what we'll do next is walk through 3 different use cases of when someone could use a covered call strategy, right? So in the first case, right, so you have Nishank, right, who thinks ABC stock will go up in price, right? We have 100 shares of ABC. And his goal is to maintain the shares, right? So keep it, don't sell it, right? And generate income along the way, right? In the second use case, you have Gina, right? And she also owns 100 shares of ABC. And her thesis is that ABC will stay flat, right? As opposed to the first thesis, which is it'll go up in price. So her goal is to also maintain the shares and then collect some premium for having a small downside protection. This is what we discussed in the last slide, that covered calls gives you a small protection. And lastly, you have Gordon, right? Gordon's actually happy to sell ABC shares above market price, right? So his goal is to sell his shares of ABC at a price, at a given price, at a price objective, right? So at his target price. In all 3 cases, the 3 users would sell a ABC call and receive the premium, right? So let's walk through that actual example, right? So they're long 100 shares and they sell 1 call, right? The 100 multipliers, so they sell 1 call. In this case, they're selling the 102 call. It's 2% out of the money, right? And they collect $2.3 per contract, right? So again, we mentioned that's 100 multipliers. So 2.3 times 100, that's $230 in premium. So each of these 3 people collect $230 of premium upfront. What happens if stock goes up? Well, stock is up $5, right? It goes from 100 to 105. And as the stock price goes up, the call price goes up. Okay. So now the call price is up to 5.2 because this call option hasn't expired yet. For those of you who understand options well, you'll know that at expiry, the 105 call will be worth $5, right? In this case, right after the price has gone up, before expiry, it's still worth 5.2 with 20 cents of time value. And what happens to our investors' positions? Well, they make a profit on the stock because stock is up. They take a loss on the option because it's gone beyond the strike price, right? And the net profit that they take at this point is 210. So they're capped out on that net profit. In all 3 cases, there's assignment risk. And we can cover this in greater detail later, but simply put, if you trade American style options, especially call options, right? And you're short these options, you always have the risk of getting assigned. and especially with upcoming dividend in play, right? So that is a risk that you need to watch out for. All right, so actually going back to the previous example, right? If you remember, Gordon's target was to sell stock, and if his price target was 105, in that case, he would actually let his stock get called away and sell it at 105, and that fulfills his goal, right? So now let's look at what happens when the stock falls, right? So it's gone from 100 down to 95, right? At expiry, that call option, the 102 call, which we collected $2.3 for, is now worth 0, right? So each of these participants collected that premium up front, right? And it helps reduce the loss. I think we have a small typo here. The net loss should be 270, right? But you guys get the point, right? That you would have had a $500 loss if you didn't have the short calls. The short calls give you a $230 premium, and it helps buffer the loss. So your net loss at the end is $270. That's covered calls. I'm going to walk through a fairly similar strategy called cash secured puts, and it's interesting because one of the basics of options is that you have two kinds of options: a call option and a put option. And one is the right to buy, one is the right to sell. One gives you a bullish exposure, one gives you a bearish exposure. So how is it that a covered call strategy is similar to, or gives you a very similar returns to a cash secured put? That actually brings up a concept called put call parity, where you can come up with the price of the call from the put. But again, let's look at what a cash secured put is, right? So what is this strategy? It is short put. That means you sell a put and you have enough cash in your portfolio, right, to buy stock if you get assigned at that strike price. So a real example could be, Apple's trading 110, right? And you sell the $90 put on it, right? Because you say, hey, I'd be happy to buy Apple at 90 if it ever falls that much, right? And you do one contract on that, right? So one contract at a $90 strike. So 90 times 100, which is the contract multiplier, right? So you need to have $9,000 in cash in order to sell one put at the $90 strike, right? So these are called cash covered puts or cash backed puts. And your thesis here is you're bullish or neutral, right? You're bullish because effectively you want stock to stay where it is or go up, right? Because then you collect that premium that you got from selling that put, and you can move on and put a new trade once it expires. Your max potential profit is limited, right? It's limited to the premium that you collected. Your max loss is the stock purchase price minus the premium. So again, significant, right? If you remember the covered calls strategy, right? Your max loss was also significant there, right? And as we've alluded to a few times, right? If you look at the payout charts of a cash secured put and a covered call, they look very similar, right? That's because synthetically they are about the same, right? So with that, let's look at some synthetics, right? We won't spend too much time looking at these, but if you look at calls and puts, they are the building blocks of options. They give you that choice, they give you the flexibility, right? So if I take a short put and I add a long call, right? So short put plus long call, it mimics or looks very similar to a synthetic long position. Financially, right, or economically, I get the same economics of being long stock if I do a short put and a long call on the same strike. And the reverse, right, if I'm long a put and short a call on the same strike on the same expiry, that starts looking much more like a synthetic short position. And these are important, right, because we use these as building blocks. One of the analogies I often use, right, is if you're building a masterpiece sculpture, right, you're Michelangelo, and you have to build the next masterpiece, and all you have is a hammer, right? But it's kind of hard to build a masterpiece using a hammer, right? That is effectively what using stocks are, right? It gives you a blunt tool. So if stock goes up, you make money. If stock goes down, you lose money, right? It's a blunt tool. And if you want more precision, and if you have very specific goals or targets and price targets views, you use options, which are more like a chisel, right? So you use the chisel to really fine tune what your expectation is. And you can create any of these strategies. There's many different strategies that exist in the options world, some more complex than others. We've shown here a long straddle, a short straddle, a long strangle, short strangle. We've shown ratio spreads. There's iron condors and butterflies. I've even heard the term jade dragon thrown around. So there's many different terms. You don't necessarily need to know all the terms. What is important is what happens when you combine a call and a put and a stock. And you can take those three elements in any form or shape or fashion you want and create your own strategy. Actually, with that, that is the end of my presentation. I will hand it over back to Justin.
Thank you, Nishank, for that great presentation. And we're going to ask you a few questions about that presentation. And so if you're a viewer out there, please keep those questions coming in. And we might not get to answer them all, but we have a bunch of them. Before we get into the questions about the presentation, I want to ask you a little bit about your career path and how you wound up at Cboe in your current position.
Good question, Justin. It's a circle of life kind of a question, right? So I'll start from the beginning. I went to NYU, got a master's degree in computer science. I loved coding. I'm very technical at heart, and I took a job at Deutsche Bank writing code for their tax department. Needless to say, it was slightly less exciting than I had imagined. Right? The tax department isn't exactly what I had imagined my career to be, and I saw a job opening with a market making firm called Group One. And it seemed really cool. So I applied, and they asked me at the interview, they asked me what's a call and what's a put. And, in my foolishness, I say, one is the right to buy, one is the right to sell. I don't know which one's which. So they asked me a whole bunch of questions beyond that. And they say, listen, you're good at math. We want to offer you a position at a trader trainee class. And we'll teach you how to trade options from the ground up. And it was great. I spent 4 years doing that, spent time getting coffee for all our senior traders, was a junior trader, was an assistant trader, was a floor clerk, spent time on the Amex floor, but really learned how to trade, from the ground up on the floor at Group One. From there, I moved to a hedge fund where I managed a condor strategy for them. I was the head options trader for them for a while. Unfortunately, that hedge fund shut down. And as it often happens, and from there I moved to Goldman Sachs to manage option strategies for their wealth management clients. So I stayed at Goldman for 9, maybe 10 years, managing option strategies in different capacities for wealth management clients. Eventually for GSAM, for the QIS team, the quant team, and at that point, Cboe reached out saying, "Hey, we'd love to have you come over. We have a new team that's Cboe Labs that's looking at new products and new ideas for all sorts of customers. And the job of our team is to really talk to clients across the different seats and say, what can we make? What can we do for you that doesn't exist today? Or if it exists, what can we change in it to make your life easier?" So in a sense, right, like this role really appealed to me because it helps me give something back to the options industry. And if it isn't already clear, this is my passion. Like I love options, so it was completing the circle to come back to Cboe for me.
Oh, that's great. And so the next kind of follow up to that, I'd be really curious, and I think a lot of our listeners are very curious. If you work for a bank, you've worked for a hedge fund and some other firms. What are some of the more common option strategies employed by institutions? And then are any of these same strategies used by retail investors?
Oh, great question. Depending on which kind of institution, which kind of firm you trade for, the complexity of the strategy changes. So I mentioned I worked for QIS at GSAM, right? So the quant team at GSAM, and some of the strategies that we employed there, you could call it a vol carry strategy, you could call it a dispersion strategy or whatnot. But eventually, right, they were very, very complex with lots of back testing, with a whole army of quants working on creating that back test, with creating the output for those strategies. But if I rewind back to my days in private wealth, those were slightly simpler strategies, right? So covered calls. We were doing this for a lot of our high net worth clients. They had large concentrated positions, and for whatever reasons, they either didn't want to sell it or couldn't sell it. And they wanted to monetize those positions, right? So they would do that by selling covered calls on it. And we covered covered calls in the presentation earlier today. It's almost exactly the same thing. Another strategy that I employed for those clients was short puts, right? So cash covered puts. So these clients come in, they give you some collateral, and they say, hey, I have a large portfolio, let's say $100 million portfolio, right? It's got allocations to all these different aspects, but I have 10 million in cash that's unutilized right now. I don't have any place to put it, and I want something that can, generate yield. At the same time, I don't want the exact risk that S&P gives me. So by having a put selling strategy, which is completely cash covered, it's selling 25 delta puts or lower delta puts, you get a lower risk strategy than being long the S&P, and you still generate your 5, 6, 7% yield.
No, that's great. Another question I think a lot of retail investors have is, their struggle with some of these concepts. What are some of the more difficult concepts for people to get a hold of when they're starting out? And you have any tips for them?
Yeah, it's a good question. When you're starting out with options, I think the first thing you need to be extremely aware of is, what is the leverage that you're taking, right? So if you have $1,000 in your account and you're trading on $5,000 of notional, right, then you have 5x leverage, right? Was that intended, right? Did you want that much risk? And once you break it down, most people will say maybe that's too much risk. I didn't want that much risk, right? So knowing how much leverage you have, knowing the risk in your portfolio is important. When you're first starting out, having a definite answer to what is my max loss is super important, right? So if I'm buying options, for example, if I'm just outright buying options, then my max loss is the amount of premium that I paid to go long that position. I know what my max loss is. But if I'm doing anything more complex than just buying an option, then it's important to chart out and know what my max loss is. If I have long stock and I sell a call on it, right, then my max loss is limited by the strike that I sold, right? It's really an opportunity cost. So those are things that you should know. And then lastly, right, there's a lot of literature and a lot of talk about volatility and whether volatility is low or high. I think getting some education on what is the different kinds of volatility, realized vol versus implied vol. Within implied vol, what is skew, what are term structure, and some of these terms may be confusing, and we can get into it in more detail at a later point. But having that basic understanding is really important as you start getting into more advanced options trading.
Oh, that's really great. So, I want to kind of ask you, I do have a couple questions here from the audience on covered calls and just understanding a little bit more about covered calls. The first one is, can you do a covered call at a non-standard strike price of, say, 26.35?
The short answer is yes. You could use a flex option, right? And flex options give you all the benefits of using a regular listed option. It's backed by the OCC, and you create a flex. However, if you're truly a retail trader, you probably don't have access to flex options, in which case, you would have to look at what are the options that are listed, and within the options that are listed, choose the one that most closely resembles the strike that you want. Another option for you, again, assuming you have the means, right, is, call up your platform and say, hey, I really want to trade this. And, maybe they'll humor you.
Great. And then a very similar question. You have 175 shares of a stock. Can you do a covered call on 175 shares of a stock?
That's actually a great question. And I'll tell you why, because that is an actual situation, right? Most people don't exactly have 100 or 200 or 300 or 500 shares. So when you have odd amount of shares, which is not exactly in units of 100, you can do covered calls on up to the units of 100. So if you have 175 shares, you can do a covered call on 100 shares of those. You can sell one call on it. You could sell a second call, but that would be a naked short call. That would not be a covered call, right? So I think that distinction is important, and a naked covered call would most likely be a much higher level of option strategy, right, than the beginner one. So in that case, you would, assuming you want to stay within the covered calls realm, right, you would have two options. You could either buy 25 shares more and then do two calls, or you could stick with 175 shares and just sell one call.
No, I think that's very informative for a lot of people to understand how they can do that. Because you're right. A lot of times, the exchanges standardize a lot of these strikes and the tenors,
Right.
and the shares, but there are ways to adapt to that, that not everyone knows about. And so, getting a little bit away from that, I wanted to talk about that premium you're going to receive from selling the call in a covered call strategy is going to depend a lot upon implied volatility. And just for our beginners out there, what's implied volatility and is it different from regular volatility or realized volatility? Can you explain a little bit about that?
Yeah. So to your point, Justin, right? The premium that you collect in an option, or the premium at which an option trades, depends on many different factors, right? This goes back to the options pricing 101. Like, you may or may not have heard Black-Scholes and other option models. To be honest, you don't really need to know or understand the math behind any of those models. What you do need to know is they have different inputs, and most of those inputs are known beforehand. The biggest variable input or unknown input is volatility, right? And what that means is, for a stock that moves a lot, it will have a higher volatility. For a stock that moves less, it will have a lower volatility, right? Or to put it a different way, if I'm trading insurance, right, and I'm buying hurricane insurance for a house that's on the waterfront in Florida versus buying hurricane insurance for a house on the mountains, well, those two will have different premiums, right? Because the likelihood of a hurricane in those two regions are very, very different, right? So when you have a higher likelihood of something, a higher probability of something, that's higher volatility, right? And when you have a lower expected probability or a lower expected outcome of some event, right, that's lower volatility. Now, what I just described is the forward-looking implied volatility, right? That is different from the backward-looking realized volatility. What realized volatility means is stuff that's already happened in the past. How much did a stock move in the past across the last 30 days, 60 days, 1 year, 5 years, any time period that you choose, and you can measure that, right? And you can use that as a benchmark or as a rough guide to say, how much do I think this stock will move in the next 30 days or 60 days or 90 days? And then that forms the basis of implied volatility. It also changes, that implied volatility also changes as the strike price changes and as the term price changes, right? So as the strike price changes, that's called skew, right? Because different strike price or different events, probability of events have different chances of coming true. And as you go further out in time, those probabilities again change.
Yeah, that's a great answer. And so following up on that, I think a lot of our users want to know, and this is maybe not a simple answer, is it better to do a covered call strategy with an options that have a higher implied volatility or a lower implied volatility?
The short answer to that, Justin, is it depends. And it really depends on your views on whether the higher or lower volatility in both those cases is justified, right? So I could have a stock with higher volatility, and I could still think it's cheap because I think it's going to move even more than that, right? Like a recent example could be Reddit, right? Reddit has extremely high volatility, and you could, I'm not saying you should have, you could have the view that volatility is justified and it may move even more than that. In which case, right, you would not want to sell it, right? Because you think it's going to be higher than what it currently is. And you may either want to buy it or at least not sell it. So you probably won't do a covered call, right? On the other hand, you could have a much more safe stock, right? Like an IBM or a GE or even the broad market, right? Like S&P, right? And you could say the SPX volatility is low, much lower than Reddit volatility. And at the same time, you could say, you know what, actually, I think it's still high, right? Because I think it's going to move even low. I think SPX as a whole market may move even lower than what's being projected. And in which case, I may want to do a covered call on that.
That's really good. And we've had a couple other questions from our users, and a lot of people want to know, how do you determine, when you want to do a strategy, may it cover call or the cash secured put, how do you determine the strike price that you should do? How do you determine how, the tenor of the option you want to do? What are some considerations that go into these selections?
These are great questions. I actually recommend everyone to ask yourself these questions before you get into the strategy, right? The questions you should be asking yourself is, what strike do I want to trade? What term do I want to trade, which is expiry, right? And what is my game plan between now and then, right? So, let's walk through some examples, right? Let's say you're doing a covered call strategy, and you already own the stock, so you're long the stock. So first you have to decide what is the strike price, right? So, you're long the stock for a reason, right? Because you think the stock is going to go up. That is your view, right? Now you have to ask yourself, is the stock going to go up in the short term, in the long term, and how much is it going to go up? Based on your views of how much you expect the stock to move and when you expect the stock to move up, right? You may want to sell a strike, right? That is in that range or above. So when stock moves up to your expectation, you still make money up to that point. And then beyond that point where you don't expect the stock to move, you're selling that upside to collect premium, right? It's obviously important to state and restate that your expectations are very, very important to the starting point. However, those expectations may not necessarily come true, right? So you also have to account for what happens if the stock moves more than what you expected, right? And if that happens, right, well, are you ready to get called away, right? Which means I sold the 110 strike on a $100 stock. It's up 10%. I was happy to sell stock and walk away from this position at a 10% up level. And that was my position 2 weeks back, and I still hold on to it, which means it's great. I can sell the covered call and exit the position. Or you may think that something has changed, your thesis has changed, you have new information, and you think there's even more upside left in the stock, in which case you can buy back those short calls and either roll it into an even higher strike further ahead, or just pay money and buy it back and close that position and go back to long stock, right?
That's great. Thank you for explaining all that. I think it's going to be very helpful for a lot of our viewers. And now I just want to get into a little bit more advanced topic, volatility skew. Can you tell me what volatility skew is and how this can be incorporated into the two strategies you talked about earlier?
Yeah, of course. So first of all, let's start with what is volatility skew, right? Volatility skew is it's a phenomena or the fact that implied vols change as the strike price changes, right? So when you have an at the money call or a put, and then as you visualize, right, as the strike price goes down, you have more puts that are coming in the picture, right? Out of the money puts. As the strike price goes up, now you have out of the money calls that are coming in the picture, right? And the implied vol of all of these strikes changes typically for US equities, right? Especially for broad-based equity indices in the US, the out of the money puts are more expensive than the equivalent out of the money calls, right? So the implied vol on a 105% call is cheaper than the implied vol on a 95% put. And when you compare the volatility of the two, right, that's when you say that's the skew, right? The skew is the fact that these puts are more expensive than the calls, and you can start measuring how much more expensive. Things to note, right? That the fact that out of the money puts are more expensive than out of the money calls, it's not always true. It is typically true for US equities. I remember from back in my days when I was trading Asian equities, right? I was in Hong Kong trading Hong Kong broad-based indices, and when I looked at skew there, I was shocked because upside calls were actually very bid up, and in some cases, the upside call volatility was even higher than the downside put volatility, right? So you don't necessarily see that in the US too often, but you could see it. You could see it in single names, and you could see it in names where there's a lot of speculation or upside expected. But that is skew. Skew is the fact that you have different volatilities across the strikes. Now, if you're looking at a typical US index, which has higher put volatility, right? You would think to yourself that, hey, maybe I want to sell that, right? Because that's I'm getting more premium for the 5% out of the money put than for the 5% out of the money call, right? And in order to take advantage of that, what you would do is, you have a cash secured put, right? You'd sell the 95% out of the money put. You'd have enough cash to buy stock if stock goes down 5% and you get a sign on your strike. But that's how you would take advantage of those skew phenomena.
Great, great. That's hopefully, and again, if anyone has any questions about this, please follow up with us. And some of these concepts can be a little bit more advanced, but Moomoo is here to help everyone from beginner all the way to advanced trader. And here we have another question coming in. Speaking about volatility, is there a good way to know if the volatility is higher than historical average for certain strike prices? And here, maybe we could talk a little bit about what an implied volatility ranker is and how traders can use an IV ranker in their crafting their strategies.
Yeah, sure. So again, like the question is, right, like you can look at implied vols and you can compare it to realized vols. But then, which implied vol do you look at, right? Are you looking at the out of the money put strike? And as you look at that, how do you know how much, how expensive or cheap that is over time, right? So you start then creating percentiles. You say over time, this 25% or 25 delta put or the 5% out of the money put, its long-term average is, or median or mean is, 15.6. It's now trading at 18, and that makes it 80th percentile. And that's more expensive than its median. You could also start creating a list of all the names that you're looking at in your universe. Could be the S&P 500 names. And you say, I want to create a list of the rankings of the implied vols of all of these names, right? And say, between this universe, right, this is where my name stands at. Now, Justin, you mentioned the implied vol ranker. Is that a tool that Moomoo offers? Do you want to maybe talk more about that?
That's a tool we have that's offered. And this is another thing, I think I kind of want to remind a lot of, you bring up a very good point that I didn't even think of is, there's implied volatility for every single different strike. But normally when someone mentions implied volatility, they're talking about at the money implied volatility, unless they're getting very specific here. So yeah, we do have something that would tell you, over the past year here, this implied volatility of a 1 week at the money option is within 90, is in the 95th percentile or the 10th percentile.
That makes sense. I mean, that's, again, to give some context, right? Those are some of the maths or some of the analytics that we were looking at the hedge fund, at Goldman Sachs, at different banks. When you start looking at volatility and start figuring out, is it expensive or cheap? You look at how has it historically been, where is it versus its historical self. And then you also add a layer of looking ahead. Why is it different? Are there any expected events that are coming up, right? So if I look at S&P vol in November, why is there a bump over there? Well, there's U.S. elections coming up. So obviously there's a bump there, right? That's obvious. But if you just look at historicals, you may not necessarily know that context, right? So it's important to know that for future-looking events or for future-looking volatilities, you do have to start figuring out what is going to happen between now and then, and how do I account for that?
Yeah, that's a very good point. And speaking of that, what I did want to ask you about was dividends. So, not every stock pays a dividend, but there are some dividend payers out there, mostly on a quarterly basis. And how does that affect options and volatility? And should you just not care if you're an investor, or what do you have to be aware of dividend wise when you're doing an option strategy?
It's really a great question. It's something that trips up people with covered calls quite often. Stocks that pay dividends are prime candidates for getting early exercised or getting assigned on those short calls. There's a lot of math around, what is the price of that call option, if it's in the money, and when it's in the money, you can break out the premium into intrinsic value, which is the value that's the value of the option, between its moneyness and the current price. And what is the time value, right? Which is just the optionality. And when you compare the time value of that option to the expected dividend, that gives you a good sense of whether that option could be exercised early or not. And what this is just a very long way of saying that if you're short a call option, especially an in the money call option that has a dividend that's going to be paid out, you have to watch out for exercise risk or assignment risk, because you may expect that option to stay the way it is all the way through expiry, but unknown to you, right? You may get exercised on it before expiry, and now you have to provide the stocks that underlying that short call option.
Well, thank you so much. I think this has been such an informative webinar, and we do have time for one last question. And I think we talked about a lot of stuff. We talked about is somewhat theoretical and then somewhat market based. But want to get a little bit more into when people go out and do these strategies. The one thing I want to touch on is liquidity. And here we have a question from a user. Is a wide bid-ask spread a warning sign not to consider a specific option, either for a covered call or a cash secured put? Can you talk about a little bit about liquidity, market pricing, and stock selection when it comes to some of these strategies?
Again, great questions from the audience and from you, Justin. Liquidity should be one of the factors that you look at, when you're trading options. And looking at the size and the width of the bid-ask spread is part of looking at liquidity. Typically speaking, you find that options are most liquid and have the tightest bid-ask spread around the at-the-money levels, and also around levels which are, let's call it the out-of-the-money calls and the out-of-the-money puts, right? When you reverse that, right, when you go deep in the money calls and you go deep in the money puts, right, the bid-ask spread could be really wide, right? And if you're not an experienced trader, you may not have a good sense of, what the actual price should be and how much premium to expect that thing to trade at. So, we looked at covered calls and we looked at cash secured puts, and the payout diagram for both looks very, very similar, right? There is a difference though, right? It's only similar if you use the exact same strike, right? Now let's consider what that means, right? In practice, right? I'm selling the 105% out of the money call to make it a covered call. Okay. 105% out of the money call should be somewhat liquid, should have a tight bid-ask spread. The equivalent put is now a 5% in the money put, right? And those puts are generally much higher premium and have higher or wider bid-ask spreads, so they're less liquid, right? So, if you are looking at putting that strategy on, right, you're probably better off doing the more liquid part of the curve, looking at which options have a tighter bid-ask spread, versus the options that are in the money. Now, I'm not saying in the money option cannot be traded, and for the more liquid options, these options have extremely tight and liquid markets all the way through the curve, on strikes and on term structure. So some of this depends on which product you're looking at and which strikes you're looking at. But a good rule of thumb is the at the money levels and the out of the money calls and the out of the money puts are the more liquid parts of the curve.
That's a very good point. And one thing I've told people to consider is when you do want to do some of these in the money options, not to use a market order, but to use a limit order, and then look at even if you want to do the in the money, look at the opposite out of the money call or put, whichever one you have, and look at what that implied volatility is. And Moomoo has an options pricing calculator that you can put all the inputs in there to give you an idea of what that implied volatility is on the tighter bid-ask spread, and then you can use that knowledge to price, to figure out how much you want to pay for the in the money option.
Fantastic. I mean, I would certainly do that, right? Like if I'm trading the in the money calls, in the money puts, right? The first thing I do is look at the out of the money side and use those inputs to help me or guide me towards the in the money side. So, I echo that sentiment from Justin.
Well, thank you so much for being on the webinar today. And for everyone out there, please know I had a few questions about the recording. We will have a recording of this on YouTube, so stay tuned. We'll be able to give that, push that out on email when that's available. And then we will have a new webinar coming up on June 13th, and that will be live from Chicago and the Cboe trading floor. So look out for that. I'm excited to go out to Chicago. And again, the day before that, June 12th, we do have that live event where we'd love to have everyone here. Please look out for the details on that event. Again, thank you, Nishank. Do you have any last closing words for our audience?
I mean, honestly, just, enjoy options. I think they're one of the finest instruments in the financial markets. Trade responsibly, like know your leverage, know your max loss. And, like any other tool, right? If you use it the way it's intended to and you use it responsibly, it will help you with your investing goals.
Great. Thank you very much. And stay tuned next time. Thanks for everyone that stayed to the end.